Hello viewers, welcome to this lecture on the course on mathematical finance. This is going to be the 11th lecture of the course, where we will continue our discussion on portfolio theory. And remember that we have already talked about the minimum variance line, and we had just given some of the introductory basic framework for the capital asset pricing model. So, accordingly, we first talk about the capital market line. The capital market line, which we will abbreviate or acronym as CML, and this is the line you would recall which joins the portfolio of a purely risk free security and no risky security, represented by the point 0 r in the mu sigma plane and the market portfolio with coordinates sigma m mu m, the weights of which we derived in the last class, satisfies the equation, and this equation is nothing but the equation of a line joining 2 points. So, it is going to be mu minus r over sigma minus 0 is equal to mu m minus r over sigma m minus 0, which implies that mu minus r is equal to mu m minus r divided by sigma m multiplied by sigma, and this can be written in the form mu is equal to r plus mu m minus r over sigma m into sigma. So, we can make the following observation given this particular relation for the CML. And remember, here r is the risk free rate and mu is essentially the return that you actually get for your risky investment. So, for a portfolio which lies on the CML and has the risk sigma, of course, with the corresponding return mu, the term mu m minus r over sigma m into sigma, that means this particular term here, this term is called the risk premium. Why do I call this the risk premium? It is called the risk premium because given a choice between a completely risk free investment and an investment which incorporates to a certain extent the risk as given by any portfolio on the CML, then the return of the portfolio will be the return that you get from the risky asset, the risk free asset rather, and the risk premium. So, in some sense it means that if you are not willing to take any risk at all, then the return that you are assured is capital R. However, in the event of taking a risk, then you can expect that you will basically get an additional return given by this term here over and above the risk free return that you are assured if you do not want to invest in any of the risky asset. So, this is the additional component or incentive which is referred to as the premium, because you have decided that you are going to take position in risky asset also in addition to the risk free asset. So, now I can state this as, this can be viewed as the additional return above the risk free return R, which is essentially a compensation for the exposure to risk. So, to elaborate a little more on this, in effect we can state the following, that everyone will combine an investment in the risk free security with just one risky portfolio, namely the market portfolio. So, instead of going and investing in individual securities and working out the weights, one can basically take up a risky position simply by making an investment in the market portfolio. So, then consequently the relative proportions of risky assets held in this portfolio will be the same for all investors. So, this is possible only when the weights in the market portfolio M are proportional to the total value called market capitalization of each of the risky assets available in the market. So, what I mean to say here is the following, is that for the investment in risky assets, all investors take up an investment in the market portfolio, and if all investors are investing in the market portfolio, that means the proportion of the money invested in each of the assets of the market portfolio or the weights of the market portfolio are going to be identical across all investors, and this can only happen if this particular portfolio reflects a portfolio where you include all the assets that are available in the market, with the weights being the same as the market capitalization of each of the asset divided by the total market capitalization of all the assets that are available in the market, which is the justification for why this particular portfolio is referred to as the market portfolio. So, since you cannot actually invest directly in all the assets in the market, so the next best thing that you can do in terms of in a practical view of investing is the following, that in practice a market portfolio can be represented by a market index. So, what this means is the following, is that if you decide to follow the capital market line and you want to make an investment in a risk free and a risky asset, then all you need to do is that for the risky component of the asset, you invest in the market portfolio, which in practice would be equivalent to investing in just a market index like say Sensex or Nifty. We now start off on the discussion on the capital asset pricing model, which is another key component of portfolio theory. So, capital asset pricing model is typically abbreviated as CAPM or usually called as CAPM. So, in case of a portfolio of assets, it may turn out that the standard deviation of individual assets may not be as relevant as the covariances between them. So, let us just sort of elaborate on this through a little example. What I mean by that, the variances or the risk of the individual assets might have a lesser impact on the overall risk of the portfolio as compared to the collective behavior as given by the covariances between the returns of the assets, and this is what we are going to illustrate through a very simplified example of a portfolio comprising of n number of assets. So, in this example, we consider a portfolio of n number of risky assets with weights Wj is equal to 1 over n. Further, we assume that the individual variances for each asset sigma j square is bounded by some L for each j. Then sigma v square, which is the variance of this portfolio of V, is going to be double summation over I and j, j is equal to 1 to n and I equal to 1 to n, w I, well, let me make this j and this is k. So, w j w k into c j k, where w j is the weight of the jth asset, w k is the weight of the kth asset, and c j k is the covariance of the two assets. And this can be split as summation over j, j is equal to 1 to n of w j square sigma j square plus summation I equal to 1 to n, j is equal to 1 to n, I not equal to j, w j w k c j k. And this can be written as, now note that we had chosen our w j to be equal to 1 over n, and we have assumed this bound on the individual variances on the returns of all the assets. So, this is going to be equal to less than or equal to 1 over n into L, because this is going to be 1 over n square and I sum this over n. So, this will give me n over n square, which is 1 over n, and for sigma j square, recall that this is all bounded by some capital L. Now, here this is 1 over n and this is 1 over n. So, this term will simply then become 1 over n square double summation j is equal to 1 to n, k is equal to 1 to n, c j k. Now, we assume further that all of diagonal elements of the covariance matrix C are equal. By this I mean that C j k is some constant C greater than 0 for all j not equal to k. Then this expression for sigma v square is going to be bounded by L over n plus 1 over n square into n minus 1 into c, which tends to c as n tends to infinity. So, this illustrates the point that I was trying to make, that you see that the overall variance of the portfolio is bounded by this quantity which tends to C, which is contingent only on the covariances of returns of different assets, with no role showing up here explicitly for the covariance or for the variances of each of the individual assets, namely sigma j square. So, taking a cue from this, that sometimes the individual variances, even though they are suggestive of the risk of the assets, they might have a lesser impact on the overall portfolio risk, whereas the covariances of the returns of those assets might actually have a more dominant role to play. So, now we can make the following observation, that the risk of a portfolio containing many such assets is determined by the covariances. So, in this example this was determined by C, with the variances of the individual assets becoming irrelevant for large n, that is for n tends to infinity here. So, what does this do? So, this example now here, this example motivates the distinction between two different kinds of risk, that is, first one is what is known as the diversifiable or specific risk, and this actually can be reduced to 0 by expanding the portfolio, and the second is undiversifiable or systematic, or sometimes which is known as the market risk, which cannot be avoided since they are linked to the market. So, let me elaborate a little bit on this, that when you are looking at the risk of the overall portfolio as given by sigma v square, there are two components. One was which had sigma j square, which was some sort of a localized or specific risk applicable just to those individual assets, and the risk contribution from that particular term can effectively be gotten rid of by taking n to be larger and larger, which means that by taking a diversified portfolio. So, which is the reason why that since you can get rid of this particular term by diversifying the portfolio, such a kind of risk is referred to as the diversifiable risk. However, in the second case, irrespective of how large you make your n to be, and in the particular example we saw that that particular term which had the covariances, the term did not vanish irrespective of how large you make your n to be. So, this means that whatever effort is put into diversifying the portfolio or making large n, that is ineffective in getting rid of this particular term, and that is the reason why this is called as a non-diversifiable risk. And this means that this is something like a market risk, because it captures the correlation of the returns of the each individual assets with every other different assets. So, on a broader spectrum we can view this as that this is reflective of the overall collective behavior of the market. Okay, so now let us move along a little more on CAPM. So, we begin by recalling that the capital market line is tangent to the efficient frontier of all risky assets at the point of tangency sigma m mu m, representing the market portfolio with weights W m. Now, consider any other portfolio V which is represented in the mu sigma plane by the point sigma v mu v in the sigma mu plane. Next, we consider all portfolios constructed from M and V, that means, a combination of the portfolio M and V, in which case they form a hyperbola which will be tangent to the CML at the point of market portfolio, namely sigma m mu m. If this hyperbola were to intersect the CML, this would contradict the fact that the slope of the CML is the maximum. So, let us see how this looks like graphically. So, this is my sigma mu plane, and this is my completely risk free portfolio, and this is going to be the hyperbola, and this is the tangent line, and this is the CML. So, here the CML intersects the hyperbola at the point sigma m mu m, and this is the portfolio sigma v mu v. So, just to recall the observation, the CML cannot have both steepest slope and also intersect the two asset line through M and V. So, then how do we resolve these issues? So, we shall now compute the slope of the tangent line to the hyperbola at M, and then use the fact that the slope of the CML must be the same. So, this means that, so accordingly let the weights. So, we look at the portfolio comprising of this portfolio V and M, and we will choose the weights of V and M accordingly. So, let the weights of V and M in the portfolio. So, the resulting portfolio I will call this as portfolio P on the hyperbola be given by x and 1 minus x respectively. Then what is going to be sigma p, or the risk of this portfolio? This is simply going to be x square sigma v square plus 1 minus x square sigma m square plus twice x into 1 minus x covariance of k v and k m, which are the return of the portfolio V and the return of the portfolio M raised to half, since this is sigma p. Also, mu p is going to be equal to x into mu v plus 1 minus x into mu m. We then now need to compute the derivatives with respect to x in both the cases at x equal to 0. Why x equal to 0? Because x equal to 0 will comprise of just purely the market portfolio M. That is, your portfolio P is just simply going to be equal to the market portfolio. So, that means the slope in this particular case will be the same as the slope of the CML. So, accordingly, we calculate first the derivative of the risk with respect to x at x equal to 0, and this turns out to be the covariance of kV km minus sigma m square divided by sigma m and similarly mu sigma the derivative of mu p with respect to x at x equal to 0, this turns out to be mu v minus mu m. So, therefore, the slope, so from these two derivatives you can calculate the slope of the tangent line is the ratio of these derivatives which must be equal to the slope of the CML. What is the slope of the CML? Recall that the slope of the CML was mu m minus r over sigma m minus 0, and this must be the same as the slope of this tangent line evaluated x equal to 0. The reason being that I have already mentioned that at x equal to 0 we will have just a market portfolio. So, then this will become mu v minus mu m divided by covariance, this term divided by this term, covariance of k v k m minus sigma m square divided by sigma m. And this gives you, upon simplification, mu v is going to be r, which is the risk free rate, plus covariance of k v k m over sigma m square into mu m minus r. And here this particular term, which captures the covariance of the portfolio V with respect to m, this is nothing but the beta factor of portfolio V. So, we will now summarize the discussion that we have done so far and deriving this particular result as a theorem. So, the theorem is as follows, and this is the theorem of the capital asset pricing model or CAPM. It states the following: suppose that the risk free rate R is lower than the expected return mu MVP of the minimum variance portfolio, and we need this so that the market portfolio M exists, then the expected return mu v on any feasible portfolio mu v or other portfolio V is given by mu v is equal to R plus beta v into mu m minus R. Now, again this term beta v into mu m minus R is called the risk premium, and it represents the additional return required by an investor because of the risk, and because of the risk due to the link between the portfolio and the market. So, in some sense basically what this does is that it gives you that you invest in a particular portfolio whose expected return is mu v, and this is the risk premium, and this is basically the additional return that is expected by the investor because of the risk taken, and this risk here can be attributed to the factor of beta v. And if you look at the expression for beta v, this is basically the covariance of the portfolio with respect to the return of the market portfolio. Now, since the factor sigma m square is fixed, so in some sense this term is reflective of the risk that is posed to the portfolio as a result of its interaction with the market. Okay. So, now suppose we want to approximate the return k v on a feasible portfolio v by a known function beta into k m plus alpha. Remember, k m was the return of the market portfolio. Then the error in this approximation is, what is going to be this error? This error is going to be k v, which is the actual observed return, minus this approximated return beta r k m plus alpha, and I will call this error to be epsilon, and this approximation is called the residual error. So, essentially what I am saying here is that you want to figure out what is going to be a model for the return k v of the portfolio v by a model of beta into k m plus alpha, and you want to ascertain what your beta and alpha are going to be, and accordingly you define this particular error, and the goal is to minimize this particular error that you have between this value of k v and then this known function that you have asserted. So, the best approximation in the sense of minimizing the variance var epsilon, and this approach is known as linear regression, is achieved for beta is equal to beta v and alpha is equal to mu m minus beta v mu m, which is the same as r into 1 minus beta v. So, what we are doing is that basically we are making an approximation to k v making use of this linear relation, and we define the error epsilon as the difference between k v and this linear approximation, and then we take the variance. So, this is the residual error, and what we want to do is that in order to obtain the best approximation, what we will do is that we will minimize the variance of this error epsilon and take the derivative with respect to alpha and beta and set it equal to 0, and it turns out that this is achieved for beta equal to beta v and alpha equal to mu m minus beta v mu m, which is also equal to r into 1 minus beta v. So, what does the CAPM do? So, let us just make an interpretation of this, of the result that we have done in case of CAPM. So, the CAPM describes the state of equilibrium in the market. So, basically everyone is holding a portfolio of risky securities with the same weights as the market portfolio, and any trades that are executed by investors will only affect their split of funds between the risk free security and the market portfolio. So, what this means is the following, that initially everyone is at an equilibrium and they have invested in the risk free asset and the market portfolio in some proportion. So, which means that everybody's risky investment is identical in nature. However, if a disturbance is caused to this equilibrium, and by this I mean that any trade that is executed by the investor, that means the investor decides to buy some additional asset or add some additional asset from the risky component, namely the market portfolio, then it will affect only their split of the funds between the risky security and the risk free security. And so, as a consequence of this, any new information about a particular security V, so that means the portfolio V might just comprise of only one security, can affect the expected return mu V or the beta factor beta V. So that as a consequence, the CAPM formula that we have derived, this CAPM formula does not hold anymore. So, suppose let us just look at two cases to illustrate this point. So, first of all, suppose that so what I am assuming here, that this disturbance has caused the mu equal to r plus beta v into mu m minus r, this has been violated. So, then let us look at the two consequent possibilities. So, mu v is greater than r plus beta v into mu m minus r. So, in this case, the demand will exceed supply, because mu v is greater than the performance given by the CAPM. The consequence of this is, when the demand will exceed supply, is that the price of security will rise, and when the price rises, so obviously the expected return will decline. Likewise, let us look at the other case when mu v is less than r plus beta v into mu m minus r. So, in this case, investors will want to sell, and the reason they want to sell is that because mu v is less than what you would get from the CAPM formula. So, investors will now want to sell. So, when there are a large number of investors that are trying to sell, the consequence of this is that the price will fall due to excess supply. And finally, what is going to happen is that the expected return, when the prices fall, then the expected return will increase. So, to sum it up, in both cases we observe price adjustments, right. That means, in this case the price of security rose, and in this case the price of the security fell. So, in both the cases we observe price adjustments restoring the CAPM formula and consequently the state of equilibrium. So, this brings us to the conclusion of this discussion on the capital market line and CAPM. And in particular, what we have looked at is that we have looked at how the market risk can actually play a much more vital role as manifested by the term beta v to the overall risk of the portfolio as compared to the risks that are being contributed to, or the risk contribution of each of the individual assets. So, finally, we will go ahead and conclude the discussion on portfolio theory by discussing more about performance analysis in the next class. Thank you for watching.